Welcome to this month's finance update. I'm Mario Borg. Well, just when you thought the dust had settled, out comes another credit policy change, which is a game changer when it comes to borrowing more money, particularly for property investors. When assessing your borrowing power, banks and lenders account for any existing home loans you currently have, as these are commitments you need to keep making, which makes sense. However, rather than using the actual interest rate you are paying on your home loans or the actual repayments you are making, banks will load your current interest rate to include a buffer. This buffer is to stress test your current loan commitments and mitigate risk for the lender, as they want certainty you can still afford the loans should interest rates increase. This rate is loaded by as much as 4%, and repayments are assessed on a principal and interest repayment basis, which is a bit over the top in my view, given the current low interest rate environment that we're currently in. Up to very recently, a few lenders on our panel took a common sense approach when assessing your borrowing capacity, as they took the actual repayment amount for your current loans and loaded it marginally to include a buffer as a risk mitigation strategy. If you were making interest-only repayments, then this worked in your favour. However, the game has now changed. Banks and lenders have been forced to tighten up their credit policies further, which in a way is positive for a healthy and sustainable property market. APRA is behind these changes, as the regulator wants to curb investor lending further because of a fierce property market which we've all been experiencing. The new rules have resulted in the bank or lender working at your current repayment commitments on a higher loaded rate, which is between 7.5% and 8% commonly used these days. The bank will also assume you're making P&I repayments on your current loans, even if you're actually making interest-only repayments. This will have a significant impact on your ability to borrow more money, and unless your household income, including your investment income, is strong, then you'll find you'll reach your maximum borrowing capacity much sooner. There are a number of strategies which you can use to ensure you optimize your borrowing capacity. These include the following. Make sure that all your current loans are on the lowest interest rate possible. Ensure that your properties are not cross-collateralized for maximum flexibility. Find a way to improve your household income. Pay off any unsecured loans as fast as possible, and reduce or cancel your credit card limits. My advice is to build financial buffers at every opportunity by gearing your properties to as high as possible, as much as your borrowing capacity enables you to. Remember, the rules can change at any time. If you think about it, the most sought after commodity by property investors is mortgage finance, as this enables you to continue to grow your property portfolio. Savvy property investors know that to create more wealth through property, the secret is to continue to borrow more money and to keep buying. But keep in mind that as your loan portfolio grows, so do your loan repayment commitments, and you should therefore only take on debt you can afford. Cash flow is important. Be smart and continue to invest, but don't be foolish and overcommit. If you are a property investor, or you want to be, an experienced finance strategist or an experienced mortgage broker with a large investor client base is the best person you can have in your corner right now. This will ensure that you are strategic about your lending and that you can optimize your borrowing power at all times. For more information about the recent changes, or for specific advice relating to your borrowing power, I can be contacted on marioborg.com.au. Until next month, take care, and I'll look forward to bringing you more finance tips and strategies at our next catch-up.